China's colossal economic decline is sending shockwaves worldwide. From a roaring dragon to a struggling giant, explore the dramatic twists impacting the global economic landscape. China is dealing with the opposite issue as the rest of the globe, which is growing living expenses, declining prices. As consumer prices dropped by 0.3% in July, the second largest economy in the world formally entered deflation for the first time in 2 years. In contrast to the general worldwide trend of rising costs for everything from energy to food, prices have already plateaued for most of 2023. Although consumers may find decreased costs alluring, economists believe that deflation is harmful for the economy. When prices decline over a protracted period of time, individuals spend less and businesses curtail production, which leads to job losses and reduced wages. The latest in a string of warning indicators that cast doubt on the durability of China's post-pandemic recovery is the country's economic descent into deflation. Although China has already experienced deflation, this time around, price decline is of greater worry to experts. When prices last decreased at the beginning of 2021, millions of people were in lockdown, and enterprises were closed because of COVID restrictions. After removing its tight zero-COVID limitations in the latter part of last year, China is currently thought to be well on the path to recovery. China's recovery hasn't been all that exciting thus far. Despite the fact that the economy has recovered from the pandemic's low foundation, numerous investment firms have reduced China's prognosis for 2023 because they believe Beijing will not be able to reach its aim of roughly 5% without significant stimulus measures. Chinese customers are still hesitant to spend at home after ongoing torturous lockdowns, depriving the economy of a crucial boost in consumption. Because of the uncertain prognosis for the world economy and the ongoing geopolitical unrest, foreign nations are purchasing fewer goods from Chinese firms. This bleak picture comes at a time when the Chinese economy desperately needs a boost in the face of rising difficulties, such as a record low birth rate, huge levels of local government debt, a sagging real estate market, and high rates of youth unemployment. China is the second largest economy in the world. How did it get there? All of this began in 1978. Deng Xiaoping was in control at the time. Because of the significant reforms he pushed through, he's often referred to as the architect of modern China. But the magnitude of the shift triggered could perhaps surprise him. China began a 45-year transition from a mostly agrarian nation to the economic powerhouse we know today by opening up to commerce and investment. Even though there's a lot of worry about growth in China, it's vital to keep in mind that the economy is still expanding and that most experts continue to predict growth. The property sector, which makes up roughly 1/3 of the GDP, is the most severe of many problems that are threatening China's economic future. Due to the historical reliance on local governments throughout China on land sales as a source of income, there's an incentive to support real estate development, even when supply outweighs demand. As a result, there are more abandoned housing developments, known as ghost cities, and unnecessary infrastructure like so-called bridges to nowhere. Some calculations place the percentage of vacant flats in the housing supply at up to 1/5 in 2019. When big developer Evergrande defaulted on more than $300 billion in debt in 2021 as a result of Beijing's measures to limit over-borrowing, the market's fragile foundations became evident. Since then, a number of other significant developers have been affected by the crisis, notably Country Garden, which was the top developer in China by sales in the previous year, and is today purged on the verge of a $200 billion default. According to Christopher Bedore, Deputy China Research Director at Gavical Dragonomics, the way that Japan and China are similar is that there's an open question about whether they've been overinvesting and piling up a lot of debt. That means they'll experience slower growth as a result of having to eventually pay off the debt. According to data by Gavical Dragonomics, 53 state developers were responsible for 174 billion yuan of the overall debts owed by 86 non-state developers last year, which totaled 725 billion yuan. Beijing would almost certainly step in to stop the real estate market from collapsing completely, but other experts think officials may view the current situation as a painful but necessary corrective to China's reliance on construction-driven development. That is a risky strategy, and things can spiral sideways in the market very, very quickly, warned Bedore. And because of the ongoing question of whether or not they'll save the firm, all these real estate developers keep appearing in the press. Beijing has been reassuring investors that it is once again open for business with the rest of the globe. The red carpet is being rolled out for people like Jamie Dimon of JP Morgan and Elon Musk after years of a difficult business environment under Xi Jinping. However, the Chinese government is aware that reviving the private sector is crucial if it is to somehow revive economic development. There is no doubting the dire state of the Chinese economy, and despite Beijing's pledges to strengthen the private sector and protect firms, these efforts appear to be failing. Data on the nation's economic activity for July portrays a troubling picture, with important metrics, including retail sales, industrial production, and investment outputs, falling short of forecasts. This has increased worries about a slower, more prolonged downturn in growth. Since the start of the second quarter, data pertaining to China's economic activity has fallen short of expectations, which has caused some major concerns, as seen by trepidation in international markets. However, China's economy has experienced difficulties before. China experienced comparable shocks during the 2008-2009 global financial crisis and the 2015 capital outflow concern. But in both cases, the government encouraged infrastructure development and boosted the real estate markets, resulting in a stronger Chinese economy. Beijing's excessive infrastructure spending over the years appears to be coming back to haunt them in the form of heavy debt, while the housing bubble had already burst during the pandemic, beginning with the Evergrande debacle. The pandemic-related global slowdown has made the combined impacts much more dangerous for the nation's financial viability. According to experts, China's declining domestic demand may deal a significant blow to the country's economy and foster a lackluster atmosphere for private sector investment. China's economic problems might worsen in the future as a result of the rising imbalance between consumption and investment if household expenditure stays low. Recent economic activity reports have depicted a bleak image, and many believe that without a boost from fiscal stimulus, China may find it difficult to achieve its goal of 5% growth in the current fiscal year. The Chinese real estate markets are also under more stress, which is concerning considering they represent nearly a quarter of the nation's economic activity. If things don't change, China may be headed for economic stagnation, which might hamper its expansion for years. With unemployment rates growing quickly, consumers and small business owners across the nation are already suffering from the economic recession. Increasing the share of household spending in GDP is now China's most important strategy for combating the downturn. However, if this effort fails in the near future, the continued economic unrest in China may have far-reaching effects on the rest of the world. Investor apprehension over political difficulties, particularly those between China and its major adversary, the US, has clouded the economic picture. The two nations continue to disagree over matters like Taiwan and access to cutting-edge technology, despite US officials traveling to Beijing in recent months to restore confidence and ties. We've already noticed a shift away from Chinese supply chains to the US, or de-risking. Western multinational corporations are making more of an effort to remedy this by sourcing more of their products from Southeast Asian nations or nations like India. However, if China's relationship with the West prevents it from accessing any of this crucial new technology, that will cause problems down the road. The key is regaining confidence. Years of widespread regulations and crackdowns have wreaked havoc on businesses, which Beijing is now working to undo in an effort to boost development. In November 2020, the IT industry in China showed its first signs of distress. So far, all we know is that China has put on hold the IPOs in Hong Kong and Shanghai. A subsidiary of billionaire Jack Ma's empire, the fintech behemoth Ant Group, was preparing for what was expected to be the largest initial public offering in history. But the Chinese government cut the project off only days before it became public. That set off a series of events that rattled the markets. These were unprecedented, all-encompassing restrictions on the private sector that destroyed billions of dollars worth of technology, education, and property. The big picture is that trend growth has fallen substantially since the start of the pandemic and looks set to decline further over the medium term. As we peer into China's economic landscape, uncertainty looms large. Is a collapse imminent, or can it weather the storm? Join the conversation and stay informed. The future awaits your insights, and do subscribe.